All right. Good morning, everyone. My name is Diana Shulak. I am here today from Family Focus Resource Center. We are so happy to have you all with us today, and we welcome you to taxes, IHSS, and retirement. Well, actually, it's IHSS, taxes, and retirement in that order. And we're being hosted today with this great presentation by the Latino tax coach, Eduardo Iniguez. He's done this presentation for us for the last 2 years, and it's one of our most watched videos on our YouTube channel. So we are very lucky to have him here today. I did put some reminders in the chat to please make sure to register for our newsletter so that you keep getting updates about these workshops, and so you don't miss any great ones just like this one. And we do try to record all our workshops, so we do put them on our YouTube channel, and I will be putting the link to our YouTube channel in the chat in just a few minutes, but we welcome you, and I'm going to go ahead and hand it off to Eduardo.
Thank you very much, Diana. So yes, thank you once again to you, Diana, and Family Focus Research Center for the invitation. Like you mentioned, this is the second year we are collaborating, and I'm glad to be here again, once again, to provide you with all the audience with this valuable information, which is related to taxes. And the timing is just perfect because we just started the tax season a couple of days ago. So, and just like any other year for you living care providers, you always have a lot of questions because your income is special for IRS purposes. So, and because that's special rules, there always creates a lot of confusion of the things that you can do and the things that you cannot do as far as filing a tax return, credits, et cetera, et cetera. So that's going to be what we're going to be covering in today's presentation. Let me get the presentation here up and running. Um, can you just verify, Diana, that you can see the presentation on
Yes,
screen?
yes, we
Okay,
can see your
awesome.
screen.
Okay, so once again, welcome everybody. Today's presentation is going to be taxes and IHSS. And yes, we're going to talk about retirement as well. So we're going to be mainly focusing on the tax portion of IHSS. That is the main topic for today. And we're going to add some additional information. Like I mentioned, also we're going to be talking about retirement because the special rules that are tax laws that apply to IHSS also have a significant impact in your retirement. Just a little bit about myself. My name is Eduardo Iniguez. I'm the founder of Latino Tax Coach, LLC, a small tax preparation office located here in the city of Commerce in the LA area. I'm in tax and financial planning expert for IHSS providers. So this is my specialty. My specialty is filing tax return for living IHSS providers. I have 10 years of experience, so I've been a tax preparer for a decade now. And additionally, aside from being a tax preparer, tax expert, I'm also a father of two children with special needs. I do have two children with autism, and the IHSS program itself, we also have it at home. So not only do I know about the laws that applies for taxes, we also experience the benefits of this program itself. And like I mentioned, I'm not only in my office, but I'm also located in the city of LA. So enough about me. Let's jump into today's topics. So today's agendas. The first thing that we're going to be talking about is the tax laws towards the IHSS income. We're going to be mainly answering the question, who is exempt? Not every IHSS provider is tax exempt. You have to meet some requirements in order to receive this benefit. So we're going to be going over those special rules. And the second main point for today's agenda is going to be the retirement portion. Like I mentioned a few seconds ago, also the special laws, IRS laws towards IHSS, they also have a direct impact on your Social Security benefits, specifically your retirement benefits. So we're gonna be discussing what are the benefits of being tax exempt, and also what are the drawbacks of the same laws. Um, Third topic on our agenda, we're going to be talking about the special rules also for our dependents with disabilities. The IRS has a special note when it comes to our loved ones who have any types of disability, and you as parents as well always have this question whether you can still claim your disabled child in your taxes, especially that question arises when they get older, as they get older. So we're going to be answering that question. The fourth topic in our agenda is going to be about the credits. This is kind of like the favorite part for most people because we're going to be looking into what type of tax credits you can receive when you file a tax return. And lastly, we're going to just take very few minutes to just give you a quick update in regards to Medi-Cal and Social Security benefits. Again, we're not going to spend a whole lot of time on that last part. I just want to give you a couple of updates. Now, before we jump into the actual tax law towards IHSS, we need to start with the basics. The first thing that you need to understand before we jump into the tax laws for IHSS is that there are different types of taxes. Not all taxes are the same. They're all designed for different purposes. Typically, any person who works in the state of California, they're usually subject to 5 types of taxes. Those 5 types of taxes, I'm going to divide it into 3 different groups. The first group that we're seeing right here is the federal and state taxes. This is the purpose of this tax is just pretty much the way we, the citizens, the way we fund the government. This is the way that both the federal and state government raises money, in order to implement some various types of projects. So this is going to be the first group of taxes. The second one is called the FICA tax. It says FICA and Medicare. Technically speaking, FICA is composed of 2 types of taxes, the Social Security tax and the Medicare tax. The reason I put it separate as FICA and Medicare is because I just wanted to reflect exactly as it shows on your pay stub. If you look at your pay stub from IHSS under deduction, that's how they're labeled, FICA and Medicare. So I just wanted to reflect exactly as it shows there. But for the purpose of this presentation, from now on, I'm just going to refer to this group as the FICA tax, which once again is composed of 2 types of taxes, Social Security tax and Medicare tax. The purpose of this type of tax, the FICA, is to fund your Social Security benefits, which includes your retirement, disability benefits, spousal benefits, and also survivor benefit. So this is the purpose of paying the FICA tax. The last group of taxes is called the California SDI. SDI stands for State Disability Insurance. So as the name implies, it's a type of insurance that will cover any worker within the state of California in case they have a non-work related injury. So these are the basics. These are the 3 groups of taxes that, again, any employee within the state of California typically pays on their paychecks, the deductions they get from on payroll. Now that we went over the types of taxes, now let's apply the law, the regulations for IHSS providers. You as an IHS provider, in order to be exempt from any or all of these types of taxes, you need to meet certain requirements. In order for you, a service provider, to be exempt from the federal and state tax, you, as a provider, and the program participant need to live under the same household. This is the main requirement. As long as you're living under the same roof, you're going to be exempt from federal and state taxes. There's no need to have any type of relation with the program participant. It can be anybody. So that's the requirement. If you, as a service provider, do not live under the same household as the program participant, then the special IHSS laws, tax regulations they're not going to apply to you. Basically, your income is just going to be considered regular income. So you're going to be subject to all types of taxes. And once again, no special rules for you, unfortunately. So that's the federal and state tax. You need to live under the same household as the care recipient. The second group, FICA. In addition to live in addition to live under the same roof as the program participant, if you are the parent or spouse of the program participant, that will also make you exempt from the FICA tax. So only those of you are gonna once again are the ones who's gonna be exempt from the FICA. For example, also those who are not exempt are usually let me give you an example, is a care provider who are siblings. The care provider and program participant, if they're siblings, the FICA exception does not apply to them. You will be paying the FICA tax. If you are a care provider for your own parents, the FICA exception does not apply to you. Only the FICA exception only applies if you are the parent or the spouse of the program participant. For the last group, the SDI, same as it's exactly the same rules as the FICA. If you're the parent or spouse, you will be exempt from the SDI. As you can see, it does make a difference who are you providing your services to. The great majority of people who are IHSS providers is typically, one of the parents taking care of their own son or daughter. That's the majority of the cases. But there's still a significant other percentage of care providers who are just providing their services to somebody else, to another family member, or to just basically anyone. So again, it does make a difference who you're providing your services to, because that's going to determine what types of taxes are you going to be paying. And let's put it from another perspective, a little bit or more visual perspective to see, to understand what we just discussed. Again, the three groups of taxes, you will not be paying the federal and state taxes if you are not the parent or spouse of the participant. If you only live under the same household, you're exempt from the federal and state taxes. But you will be paying the FICA and SDI if you are not the parent or spouse of the participant. If you are live-in provider and you're the parent or spouse of the participant, you will be exempt from all the taxes. So that pretty much breaks down all the special rules or tax laws that applies for you live-in IHSS providers. Moving on. Now, there's some of you who do meet the requirement to be exempt from federal and state taxes. However, for various reasons, you're probably still having the withholdings, the federal and state withholdings from your paychecks. If that's the case, that money that you pay throughout the year, there's a way to get it back. And there's only one way. And that only way is for you to file a tax return. Once you file a tax return, your tax preparer needs to do some special steps within the tax form in order to request, all of those withholdings to be refunded back to you. So, and that's the only way. There's no additional what you call it, forms that you need to fill out with the IHSS agency. No, the only way to get it refunded is by filing a tax return. Now, the form that you're looking at on your screen is called it's known as the 2298 form. This is a special form that it's a little bit controversial because there's many misconceptions about this particular form. First of all, the purpose of this form is by you filling out this form is your way of telling the IHSS agency that you are exempt from federal and state taxes. And that's it. That's the only thing, that's the only purpose of this form. And I mentioned that there's many misconceptions about this form because you sometimes out there can hear some people say that if you fill out form 2298, that's gonna prevent you from filing a tax return, which is not true. Filling out this form only makes you exempt from paying federal and state taxes. It does not make you exempt from filing a tax return. So I wanted to clear the point out. And also the Form 2298, this is not a form that this is not an IRS form. The IRS doesn't really know the existence of this type of form, so they have nothing to do with it. This form belongs to it's a state form, mainly from the IHSS agency. And again, the purpose of this form is just to make you exempt from paying federal and state taxes. Another way of looking at this form, it's once again, let's look at the different types of different groups of taxes. Form 2298, it only applies to the federal and state tax. So if you decide to fill it out, it will only have an impact over this group of taxes. It does not apply in any way to the other two type groups of taxes, the FICA and the SDI. In this, by giving you this explanation, it also answers another common questions that I typically get from many of you living providers. Many of you, once you find out that you're exempt from that you're exempt from paying the FICA tax, and that you find out about the consequences of not paying the FICA tax, you typically ask, okay, what can I do to opt in back in and start paying the FICA tax so I can contribute towards my retirement benefits? And many people believe that either um, filling out or canceling out, I should say, from 2298, they think that's going to fix the problem, but not necessarily. And the reason is because 2298, it only applies to the federal and state taxes. It doesn't affect in any other way to the other two groups that are down here on the screen. Now, additionally, one of the most common questions that I also get in regards to Form 2298 is whether it is convenient for you to fill it out or just not touch it at all. What is what is what is it that you should do? First of all, I should clarify the Form 2298. It's completely optional. It is not a mandatory form that you need to fill out and turn it in. So it is, like I said, it's completely optional. What you do need to understand is what are the consequences of filling out this form or not filling it out. Right here on screen, I'm going to show you what will happen if you do not fill out this form. If you do not fill it out, you're still going to have withholdings from federal and state taxes. So you're going to still have the deductions from every paycheck that you receive. At the end of the year, you will receive a Form W-2. Within the Form W-2, it's going to show how many federal and state taxes withholdings you had throughout the year. And then once you report that W-2 in your tax return, all of those withholdings, they're going to be refunded back to you. And if you qualify also for some of the credits, that's going to add on top of the credits. So potentially you could receive a nice, healthy refund. So this is the scenario, what could potentially happen if you do not fill out Form 2298. Now let's look at the other side of the coin. What will happen if you do fill out this form? So once you fill it out, that's gonna start. You're not gonna have any more withholdings, federal and state taxes only. At the end of the year, if you are the parent or the spouse of the program's participant, you will not receive a Form W-2. I will go into detail in the next couple of slides of why you will not be receiving it, but only those of you who are, again, the parent or the spouse of the program participant, only you will not be receiving the Form W-2. All other um, all other people will be receiving the W-2. However, if you do not receive a Form W-2, there's still a way that you can file a tax return. And it will be convenient for you to do so, to file a tax return, because you could potentially qualify to receive some refundable credits, mainly the child tax credit or the earned income credit, or both, depending on your particular case. We're going to be discussing about the types of credits in a couple of slides. But Once again, even if you do not receive a Form W-2, you can still file a tax return, and I'm going to also be showing you how to do so in a couple slides. And before I forget, Form 22 is one time only. Um, so you do not need to be filling, be completing this form every single year. You just have to do it only one time. For those of you who are exempt from the FICA tax, unfortunately, once you're exempt, you cannot reverse it. There's no other way that you can opt in back in to pay this tax. Um, Unfortunately, that's the end of the road for you, at least with your IHSS wages. The only way that you can still contribute or pay the FICA tax is only if you have a second source of income. So in addition to having your IHSS wages, you need to have another a part-time or be self-employed. And by having this second source of income, you will be paying the FICA tax. But unfortunately, through IHSS, once you're exempt from FICA, there's nothing that you can do to reverse it. Form 2298, that's a way of making you exempt from paying federal and state taxes. There's also another way. And the second option is by filling out Form W-4. And it's unlike the 2298 Form W-4, it is an IRS form. You do not need to send it to them, though. If you do fill out Form W-4, you need to turn it into your county IHSS agency. And the way you fill it out is just by following these simple steps. You just need to fill out step 1, which is your basic information, your name, social security number, and your merit status. And step number 5, which is your signature. And if you want to be tax exempt from federal taxes, you need to write the word exempt right exactly in that location. Make sure it's big enough so that the person that is processing your W-4 form can see that you're requesting to be exempt from federal taxes. And again, this is another way of making your wages tax exempt. If you don't want to fill out Form 2298, you can fill out Form W-4, and either one will work, and it should take effect almost immediately, and you will stop having withholdings from your paychecks. Now, Form W-2. I mentioned that only certain people will not be receiving Form W-2. And first of all, I want to explain what is the purpose of you or any individual, pretty much, what is the purpose of you receiving a Form W-2? The purpose of the W-2 is for employers um, to report both your income and your tax withholdings that you had throughout the year. So basically, if you did not have any withholdings, there's no reason for your employer to provide you with a Form W-2. So that's pretty much the reason. And it's a pretty simple explanation, because the purpose of W-2 is just to report withholdings. If you don't have anything, they're not going to give you one. And only, again, those individuals who are living providers for their own son, for their children, or spouse, those are the only group of people who will not be receiving a W-2 form. Everybody else, even if you're exempt from federal and state taxes, you will still have withholdings for FICA tax, and because of that reason, you will receive a Form W-2. Okay, moving on. Now we're gonna dive into the actual tax return. As I previously mentioned, those of you who who don't receive a W, even if you don't receive a W-2, you are allowed to excuse me, you're allowed to present a tax return with the IRS, and I'm going to show you exactly how to do it. The screen, the form that you're looking at on your screen right now is the actual form that we're going to be using for this taxable year 2023. Is Form 1040. That's the main page for the entire package. If you do receive a W-2 form, you're just going to report it on the line where you typically report a W-2 form, which is line 1A. Um, Nothing special about this line if you have a W-2. However, if you do not have a W-2, there's a special line for you folks. As you can see right there on line 1D, first of all, a little bit of vocabulary here. Medicaid waiver payments. That means IHSS. At the IRS level, they don't know this program, the IHSS program, as IHSS, Income Support Services. They know this program as Medicaid waiver payments. IHSS is just an acronym or the name of the program that we use here in the state of California. So if you ever get in touch with an IRS agent and you tell them and you have any problems related to your IHSS income, and if you mention, oh, you know what, IRS, I have IHSS wages that are exempt, the agent's gonna be like, what are you talking about? What is IHSS? So you gotta make sure that you're using the correct vocabulary whenever you are having any type of communication with the IRS in relation to your special wages. So Medicare waiver payments now reported on Form W-2. This is a special line that barely came out um, last year. So beginning with tax year 2022, the IRS finally, and I say finally because it took them over 10 years to add this line. They added the special lines for you folks who don't receive a W-2. So you don't receive a W-2, no problem. You can just plug in directly on that line um, your income for the entire year. Now, what is the number that you're going to be using on the line? It should be your total income, and you can base your total income on your last pay stub that you receive for calendar year 2023. Typically, the last payment that you receive for that calendar year is the one that shows service period December 1st to December 15th. That pay stub is going to show your gross income for 2023. So whatever says on the gross income, you're just gonna plug it in directly into that line. Well, actually, let me move forward so I can show you another tax form. If you are gonna be reporting IHSS wages, whether you have a W-2 form or not, in order to exclude it from taxes, you must have this form. It's called Schedule 1. You can see it at the top left corner and right there in red color, Schedule 1. And right here to the bottom where you have the arrow pointing down, line 8S, let's read it. Non-taxable amount of Medicare waiver payments. As you already learned, Medicare waiver payments means IHSS. So this on this line, once again, you're just gonna repeat the number that you put on Form 1040 on line 1D, just gonna transfer it over here, and that's gonna make your wages tax exempt. If you do not include Schedule 1 in your tax return, you're gonna be reporting your income, your IHSS wages as regular income, which means that you're gonna be paying taxes that you're not supposed to if you're exempt, and that's gonna create a lot of problems with the IRS. And by reporting your wages as regular income, you could potentially prevent yourself from receiving any type of tax credits. So you gotta make sure that you're using this form to exclude your IHSS wages from taxes. So it is mandatory to have Schedule 1 on your tax return. And you can, if you're in doubt if your tax preparer did the correct thing on previous tax returns, you can use the same format that we're looking here on the screen. You can look at taxes 2022, and it's exactly the same format. For tax years 2021 and prior, it's going to look slightly different. You're still required to have Schedule 1, but directly on line 8, you should have a special code. It says notice, that code is notice 2014-7. Again, for 2021 tax year and prior on Schedule 1, you directly over line 8, you had to add the code notice 2014-7 in order to include your IHSS wages, beginning with taxable year 2022 and now with 2023. This is the format that you see on the screen that you're going to be using to exclude your income from taxes. Now, let's talk about the credits. If your only source of income is from IHSS, you can only you can only receive basically just two types of credits. If you have a second source of income, or if you're married and your spouse has also regular income, that that opens the door pretty much to receive any type of credits. There's tons of credits that you can receive from the IRS, but in order to have a greater variety of credits available, you need to have at least one source of income that is regular income. But if you only have IHSS, these are the only two credits that you could potentially receive. The first one is called the Earned Income Credit, EIC. That's the abbreviation for this special credit. Now, the maximum credit for 2023 tax year, you can receive up to 7,430. But not everybody is going to receive that maximum amount of credit. Just to give you an idea, in order for you to receive exactly 7,430, if you're a single tax filer, you need to earn between 11,000 and 21,000. That is the range, your income range that you need to have in order to receive the maximum credit. And additionally, you need to have 3 dependents or more. As you can see, yeah, the credit is pretty high, but also means that your income needs to be very low. If you go above the 21K limit, you're still going to receive the earned income credit, but the credit is just going to it's going to continue to decrease as your income increases. If you're married, the income range to receive the maximum credit is between 16,000, and 27,000. That's if you're married. The other credit is called, sorry, I think my PowerPoint got a little bit messed up. This says credit per dependent, but it's child tax credit. It's the child tax credit. For this year, taxable year 2023, the maximum credit available is up to $2,000 per dependent who are 17 or under. I should say younger than 17. In other words, for 2023, they had to be 16 or younger. Once they turn 17, from that point on, your dependent will no longer qualify for the child tax credit. Dependent with disabilities. The IRS has a special rule when it comes to our children with disabilities. That special rule says that if your dependent has a permanent disability, and due to that disability, they cannot be financially independent pretty much, that would allow you as a parent to claim your child pretty much forever. But that's only if they have a disability. When there's no disability involved, the maximum you can keep your children on your tax return as dependent up to 23 years old. But that age limit gets eliminated once they have a disability. So just keep in mind, if they have a disability, you can pretty much claim it forever on your tax return. What are the benefits of claiming your dependents with disabilities on your tax return virtually forever? That will make you eligible for the earned income credit also forever. You still have to meet the income requirements, but it doesn't matter if your dependent is 30 years old, 35 years old, as long as you're claiming him or her on your tax return, that automatically opens the door for you to be eligible for the earned income credit. And once again, the only thing that is going to determine if you receive the earned income credit or not is your actual income. For your dependent, and I apologize again, somehow my PowerPoint messed up my script right here. It's called the child tax credit, not credit per dependent, it's the child tax credit. The child tax credit doesn't take into account the child's disability. They only look at their age. They have to be younger than 17. Now, up to this point in the presentation, we already went over the various types of taxes. We have three groups of taxes. We already went over um, the requirements that you need to meet in order to be exempt from any particular group of taxes. Um, so now we're gonna talk about what are the benefits. What are the benefits of me not paying taxes? The main benefits of being exempt from this any of these types of taxes, first of all, the biggest benefit is not paying the federal and state. Realistically, most people in the United States, especially those high income earners, they pay a lot of money, to get in touch with CPAs that can, give them advice as how to lower their tax liability. So they pay tons of money in order to pay less in federal and state taxes. The reason is because especially high earners, and when I say high earners is half a million and above, if you earn that much money, you're going to be paying up to 37% in federal taxes. And here in California, you will pay to the state of California up to 13, just about 13% in taxes. So almost half of your income is going to go to the government if you are high earning. So the rich people are pretty much looking for a benefit that you as a living provider already receiving. So if they want to be exempt, the rich people want to be exempt from federal and state taxes, you should as well. And again, federal and state taxes, you don't get any special type of direct benefit for paying it. Once again, the purpose of this types of tax is the way we, the citizens, fund the government. That's it. That's the purpose of that tax. So if you're already exempt, awesome. Enjoy the benefit. However, if you're exempt from FICA, that is a problem. And the problem is that you're not contributing towards your Social Security benefits, which includes the retirement benefit, among others. But that's the main one for the main benefit that most people care about because all of us want to, once we retire, have some source of income. Um, so if you're at this point where you're exempt, you need to have a plan, pretty much. You need to see what you need to do right now in order to either, in a way, try to continue contributing to your towards your Social Security benefits, or by contributing towards your own type of retirement accounts, which we're gonna be talking next in the following slide. If you're not exempt from the FICA tax, fantastic. That means that you're almost going to be guaranteed that you're going to receive a benefit when you retire. So that's great. So for the next couple of minutes, we're going to focus pretty much on those who are exempt from FICA. And usually, when you're planning retirement, one of the main questions that you should be asking yourself is how to finance my retirement. How am I going to survive once I'm completely retired and I no longer have a job or any other source of income. Unfortunately, here in the United States, statistics show that 7 out of 10 people who are currently retired completely rely on their Social Security benefits. The national average of shows that people who are currently retired receive an average of 1,900 per month. I'm rounding up the numbers, but that's the national average, so you can kind of have an idea of what to expect if you are soon to retire. So 1,900 a month for us here who live in California and other parts of the country is not much. Pretty much nothing in some cases, but it is what it is. That's how the Social Security system was designed. It was not designed to cover 100% of your income, Once you retire, it was just designed to cover a percentage of it. And the government left it up to us to supplement in any way the Social Security benefits that we receive. So ideally, when you have when you're planning for retirement, you should have your Social Security benefits in mind, and also your individual retirements account, which is the one that we're going to be talking next. But before we actually jump into the retirement accounts, let's look into the Social Security benefits. How can I receive them? If you want to receive any of the Social Security benefits, retirement, one of them, you need to pay the FICA tax. If you're basically not paying the FICA tax, you're not contributing towards your benefits. So Social Security system has a points system. Those points are called credits. You need to earn, any individual needs to earn 40 credits throughout their lifetime in order to qualify for the retirement benefits. How do you earn these credits? For 2024, in order for you to receive one credit, you need to earn $1,730 in the entire year. You can either receive a lump sum for that amount or several payments throughout the year. It doesn't matter as long as you accumulate, as long as you earn 1,730. But additionally, you need to be paying the FICA tax. So if you're exempt from FICA, mainly those of you who are live-in providers, who are the parent or the spouse or the care recipient, it doesn't matter how much you earn, unfortunately, because if you're not paying the FICA, you're not going to be receiving any credits at all. So that's how you earn one credit. Also, the law says that you can only earn up to 4 credits per year. That's the maximum that you can earn. So for 2024, in order to receive your 4 credits, you need to earn 6,920 throughout the year. And again, you also need to be paying the FICA tax. You don't pay the FICA tax, you don't get the credit. So if you get the 4 credits per year, that's the equivalent of you working 10 years to reach the 40 credit mark. Now, some of you don't know exactly how many credits you have. So the best way and the easiest way to find out how many credits you have is by creating an account in the Social Security Administration website, www.ssa.gov. And it's pretty simple. You just log into that website, just hit the button where it says login, create an account if you don't have one. It's going to take you about 10 minutes or so to create the account because you're going to be using a system that is called ID.me, which is a system that's going to verify your identity. So that's why it's going to take about 10 minutes. But once you're able to log in, the first page in your profile is going to show you exactly how many credits you have. It's going to show like a little horizontal bar where it keeps track of how many credits you have. So this is a good way for you, a great tool that you can utilize to plan your retirement. Log in into your account. If you have, I don't know, if it shows that you have 32 credits, now you learn what you need to do in order to earn more credits. So you have 32, you can just do a simple math there. It shows that you have to do you have to work for 2 additional years in order to meet the 40 credit mark. So this is how you get your Social Security benefits. You need to earn credits throughout your lifetime. Also keep in mind that if in the past you did had a regular job before you became a live-in provider, whatever credits you earn in the past, they do not expire. They're going to be yours forever. So the credits that you earned when you were 20 years old, they're going to count the same when you retire. So they're yours. You earn them, you get to keep it. They don't expire. Another thing for those of you who are married, you do not share the credits. You have to earn they need to be earned individually, not as a couple. Individual retirement accounts. Right here on the screen, I'm just going to show you the most popular types of retirement accounts. If you just do a simple Google search and looking for retirement accounts, you can get a huge list with options or things that you can do to plan to fund your retirement. I'm just going to give you the most popular ones and the ones that are more accessible for pretty much any individual here in the country. The most popular one is called the 401k. You can only obtain this type of retirement program through employment. You need to have an employer who offers this type of program. The one of the main attractions of this type of program is that some employers offer a what they call a matching program. So if you enroll in the 401k, for every dollar you put in into this retirement account, for example, your employer might also contribute an additional dollar. So in other words, you will be receiving free money that is coming via your employer. So that's a good way to accumulate, funds for your retirement by having not just you, but also your employer putting in money into the retirement account. I have to clarify that not every single employer offer the matching program. So you gotta read those details ahead of time if you're planning on, you know, um, getting higher and one of these companies that offer the 401k. You just gotta ask the questions ahead of time to see if they offer a matching plan. If they do offer it, it's always a good advice to just take it because you're getting free money for your retirement. And again, it has to be through an employer. If 401k is not an option, the second your second option could be an IRA account. An IRA account, you do not need an employer to set it up. You can just literally walk into virtually any bank or just or log into one of those virtual banks as well and just create an account. It just takes you a couple of minutes. The hardest question for you is going to be whether deciding to open a traditional or Roth IRA account. The difference between these two is if you open an IRA account, uh, whatever you contribute towards the traditional IRA account is going to become tax deductible. Quick example, if you earn 50K a year and you contribute 5K towards the traditional IRA account, when tax season comes along, you're not gonna pay. You're only gonna be paying taxes on 45K instead of the 50K. Because again, this is whatever you contribute to the traditional IRA, it is tax deductible. So it helps you save money on taxes every year when you file a tax return. The Roth IRA, on the other hand, it does not offer the benefit of a tax deduction. However, whatever earnings you accumulate throughout the time, for as long as you have it, you're not going to be paying any taxes on those earnings. So that's the main attraction of this type of account, the Roth IRA. So which one is better for you? It depends on your particular case. For example, if you are married, if you have IHSS and your spouse has regular income, you could consider probably the traditional IRA because your spouse has regular income. You will benefit from having an additional deduction on your tax return. On the other hand, if your only source of income is IHSS, perhaps by default, your IHSS income is already tax exempt. So you do not need a tax deduction. So probably, perhaps the best option for you will be the Roth IRA. There's a limit on contributions that you can make annually. If you're 50 or younger than 50 years old, the maximum contribution is $7,000 a year. If you're 50 or older, the maximum contribution is 8,000 a year. There's no minimums, but just have in mind the maximum that you're allowed to contribute. One of the hottest types of individual retirement account right now is the high yield savings account. High yield savings account, they're mainly used for short to medium, short, mainly short term goals instead of long-term goals. And but it's still a good way to fund your retirement. Right now, high yield savings account, they are at a all-time high because you're still seeing various banks out there that are offering you up to 5% in interest rates. So it's pretty decent, a decent amount. All you have to do is just open an account with them, have your money, deposit your money into the account, leave it for as long as you want in there, and you're gonna be accumulated that 5% uh, interest rate. So so again, this is mainly for short-term goals, the high yield savings account, but the interest rate is very decent, so you can consider that, consider these options as well. And the last or the most popular individual retirement account is the federal government bonds. Um, Better yet, the I bonds. These types of investment, the way they work pretty much is the following. You're essentially pretty much just giving the federal government a loan. You're loaning money to the federal government, and in exchange, the federal government is gonna pay you interest. The interest is variable. Some years it can be as low as 3%, 4%, and some years can be as high as 9% or 10%. The highest we ever seen, we just saw it a couple of years ago during 2021 and 2022. The interest rate was around 9%. So it was very, very decent rate of return. Additionally, the federal government also gives you a guarantee. If you hold on to this I bonds for a minimum of 20 years, the government is going to give you the guarantee that minimum your initial investment is going to double in 20 years, regardless of what happens with the economy. We can be in recession for continually for 20 years. It's unlikely, but if that happens, the federal government says your investment is safe and it's gonna double in value. The I bonds, you can purchase them two ways. One of them is actually with your tax return. If you have a refund, there's a special form that you can fill out within your tax return, and you can just tell the IRS, out of my, I don't know, $5,000 refund, I want to use 3,000 to purchase I bonds, and yeah, and then we just mail it directly to your home address. You will receive like kind of checks of different denominations. But yeah, you can purchase them that way. The other way to purchase the I bonds is at any time in the year via the U.S. Treasury website. You just need to create an account with them, and you can just purchase the I bonds directly there at any time of the year. You don't have to wait until you file your tax return. You can just log in into their account. Now, those are the most popular types of retirement. Now, one of the most common questions that I've been receiving just in the last couple weeks, 2 to 3 weeks, from many of living providers is about a special email that most of you receive in regards to a retirement account. That retirement account that they're mentioned on that email is from Cal Savers. Many living providers are now happy in many ways because now they're they're saying or they believe that they finally are able to have a retirement account basically. The truth of the matter is that Cal Savers has been around for a couple of years, so it's not necessarily a special type of retirement account for IHSS providers only. No, Cal Savers is available for just anyone, pretty much anybody that lives in California. That's pretty much one of the main requirements that you have earnings here from California, or actually there's a way that you can be even out of state and contribute towards Cal Savers. But it's available, it's open to everybody. What is Cal Savers? Let's start with that. Cal Savers is a type of retirement account. It's a Roth IRA, the ones that we just discussed in the previous slide. They just call it Cal Savers. but it's a Roth IRA. And we discussed the benefits of it. The benefits, again, is that it is not tax deductible. However, the earnings that you have throughout the years are going to be tax free. They call it Cal Savers is because it was created by the California government. The purpose of California, of them creating this type of program, Cal Savers, is because they noticed that not that many people are saving up for retirement. So they wanted to step in and kind of help out individuals to have more money when they retire. So that's the purpose that it was created. And it was created back into 2019. And then once again, it's available for anybody. If you want to contribute, you want to open Cal Savers. Again, the maximum contributions are 7,000 if you're younger than 50 years old, or 8,000 if you're 50 or older. Excuse me. And if you create this type of account, you can have the option to have the deductions directly from your paycheck, or you can connect any bank account that you already have and have Cal Savers pull the money directly from your personal bank account. You can do either or. Whatever you do, it's fine. So this is Cal Savers. Once again, it's not necessarily a special retirement for living IHSS providers. It's available for everybody. Just one thing for you to keep in mind, if you're already planning on opening up any type of retirement account, if you have children under 18 who receive SSI, keep in mind that these types of retirement account can have may harm the benefits of your child. As you probably know, those of you who have SSI, if you have a minor child who receives SSI, their benefits are based on the parents' income. So the rules are that you cannot have more than $2,000 in any bank account or any type of investment. If you go above that amount, it's 2,000 if you're single, 3,000 if you're a couple. If you go above the limit, your SSI benefits for your son or for your child, they can be reduced or completely eliminated. So just have the little thought in mind when you're planning for your retirement. If your child is already 18 or older and receives SSI, you pretty much don't need to worry about it. You're free to open up pretty much any type of retirement account. Lastly, before we conclude to this presentation, just a couple of updates for medical purposes. They did a really good update beginning with January 1st, 2024, and the new rule says that the limit on accumulated assets has been eliminated. A couple of years ago, for medical purposes, if you wanted to receive this type of health insurance, also you needed to have less than $2,000 in your bank account. Same rule as the SSI. Beginning with this tax year, that limit has been completely eliminated. You can virtually, there are certain exceptions, but you can virtually have as much money as you want in your bank account, retirement account, and that won't necessarily impact your medical eligibility. The main factor for medical, in order for you to continue receiving medical, is just basically going to be your income, your any sources of income that you have, whether it's from a regular job. IHSS does not count towards medical, by the way, but any regular income that you have, any income from any types of investment, that's all the only thing that is gonna count towards your income eligibility. So that's good news because now most of us can now focus completely on planning for retirement without the fear of being kicked out of medical because of your accumulated assets. So that's good news. And the last update is for Social Security. Pretty much the update is that you're getting a raise. it doesn't sound like much, 3.2%. Those of you who are already receiving the retirement benefits are gonna get a, well, they call it a really decent increase because 3.2 has been one of the highest increases in the last several years to retirement benefits. But for the majority of the people, that's just going to represent 50 additional dollars per month. I know it's just $50, but Social Security Administration is happy. They're bragging about the 2.2% increase. So, but it's also important that you know this update if you're already receiving this benefits. So, and that pretty much concludes our presentation for today. I'm gonna stop here the screen so I can take any questions you might have. Thank you for listening, and let's go to the questions.
Actually, Eduardo, can you put your screen back up
Oh, sorry.
with your contact information before we start taking questions? Because that way we can make sure that that's on the recording, because this, I want to make sure that this stays up there. Everyone, this is his website and his email, as well as his contact information. You can take a screenshot of this on your phone, but it will be on the recording. So I just want to make sure that we got this up for enough time. I'm now going to pause the recording so that we can start our questions.